India's wholesale inflation has exploded to a 3.5-year high. That's right. In the month of April, India's Wholesale Price Index, or WPI inflation, surged to 8.3%. Now, that's sharply up from 3.88% in the previous month of March. Now, the big trigger? Well, a global oil shock caused by rising tensions in West Asia. So what exactly is happening, and why are consumers not yet feeling the same level of pain in retail inflation? Well, let's first bring you the big picture. Well, India imports more than 85% of its crude oil needs. Over the last few weeks, global crude prices have jumped sharply because of fears of supply disruptions linked to the West Asia conflict. Now, Brent crude has climbed above the $100 per barrel mark and pretty much stayed there. The surge is now showing up in wholesale prices. Now, according to government data released on Thursday, fuel and power inflation under WPI shot up nearly 25% in the month of April. Now, that's up to 25% just from about 1% in the month of March. The prices of crude petroleum, natural gas, minerals, oils and basic metals have all risen sharply. And because fuel is a key input across all factories, transporters and manufacturers, the pressure spread across the country. Core WPI inflation, which excludes fuel and food, has reportedly climbed to just about 5%, a multi-year high as well. But here's where things start to get interesting. Consumer inflation, or CPI inflation, is still relatively low. India's retail inflation in April came in at just 3.48%, still below the RBI's 4% comfort target. The question is, how long will retail inflation stay low, and also why the gap between WPI and CPI? Well, because WPI and CPI measure very different things. WPI, or Wholesale Price Index, tracks prices at the wholesale or producer level. It measures the prices businesses pay for buying goods in bulk. It is also called factory gate inflation, or prices at which goods enter manufacturing units, not exit. Now, this includes input cost of commodities like fuel, metals, chemicals, as well as some manufactured goods. CPI, or Consumer Price Index, on the other hand, tracks prices paid by ordinary consumers like you and me. It includes food, housing, transport, healthcare, education, as well as daily essentials. So in very simple terms, WPI measures inflation at the factory gate. CPI measures inflation in your shopping basket. Now, WPI usually reacts faster to global commodity shocks because it directly captures the crude oil and industrial input prices. CPI, on the other hand, moves more slowly because companies and fuel retailers, for that matter, do not immediately pass on all higher costs to consumers. And that's exactly what's happening right now. Now, the government and oil marketing companies have so far absorbed a large part of the fuel shock instead of fully raising petrol and diesel prices. Now, that has helped keep retail inflation under control. Economists say core CPI inflation remains relatively subdued at just about 3% to 3.5%. Food inflation has also stayed manageable so far, though there are concerns about monsoon risks later this year. But the big question is, will this WPI shock spill over into CPI next month? The answer is very likely, at least partially. Historically, wholesale inflation eventually feeds into retail inflation with a lag of a few weeks or at best a few months. If crude oil prices remain elevated, companies may begin passing on higher transport and production costs to end consumers. Now, that could mean more expensive packaged food, higher logistics costs, costlier air travel, and eventually even higher petrol and diesel prices. Economists are already warning that CPI inflation could move closer to 4% and potentially even beyond that if oil stays elevated for longer. Now, for India's central bank, the RBI, this creates a policy headache. Retail inflation is still within target, but wholesale inflation signals a rising pipeline pressure. If WPI remains high and starts feeding into consumer prices, expectations of future RBI rate cuts could weaken. Alternatively, and more scarily, RBI can also move the repo rate needle to the rate hike side, further dampening the investment mood for individuals, corporate India and the stock market as well. So for now, India's inflation story is split in two. At the wholesale level, businesses are already facing a major oil-driven cost shock. At the consumer level, the full impact is yet to hit. But unless crude prices cool off soon, today's WPI surge could become tomorrow's CPI problem.